Hi there, thanks for joining us here at PhillipCapital's Market Watch. I'm Paul Chew, Head of Research at Phillip Securities Research. In this episode, we will discuss the Singapore equity market as a shelter in the current economic stagflation. The current economic backdrop is of higher prices, inflation, and stagnating income. We see slowing growth as lead indicators such as PMIs start to roll over. Inflation is at a 40-year high, and there is a need for interest rates to catch up. The coming surge in interest rates will become a further headwind in global growth. There are concerns that any spike in inflation can only be tamed by a recession, as reflected by the chart shown. We believe Singapore equities can serve as a shelter to this stagflation shock. Almost 50% of the Singapore Straits Times Index, or STI, will benefit from the rise in interest rates. These include banks and stock exchanges. Another 18% of the STI are beneficiaries of border reopening and removal of group restrictions in Singapore. The sector winners here are retail, telecommunications, transport, and hospitality. As for the final 6% of the STI, we consider them as re-rating sectors. Conglomerates' valuations are re-rated upwards from disposal of low-return businesses, higher dividends, and aggressive share buybacks. The defense sector is re-rated due to the Russia-Ukraine conflict, which has triggered an unfortunate global arms or military race. As interest rates in the US or federal funds rates climb upwards, it will be a windfall for Singapore banks. Singapore interest rates have around a 90% correlation with the Fed funds rate. At least another 200 basis points or 2 percentage points rise in interest rates is expected this year. We estimate a 100 basis points rise in interest rates will further drive bank earnings up by 18%. Bank gains from their huge excess liquidity or float, high percentage of low-cost funds from current and savings account, and portfolio of floating rate loans will reprice higher due to the increase in interest rates. We believe the reopening of Singapore borders and removal of group restrictions is a unique 18-month tailwind for nation's economy. Tourism is around 5% of pre-pandemic GDP. It was an important missing economic driver during the pandemic. Beneficiaries of this injection are hospitality, as hotel occupancy and room rates recover, retail, especially in the Orchard area as tourists return, transport with higher passenger volumes, and telecommunications will gain from the high-margin roaming revenue. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Thanks for joining us and see you soon.